Hey guys, Toby Mathis here. And today we're going to talk about getting the most out of your tax return. So we're going to dive right in. Hey, real quick, if you like tax information and you're willing to share it, please share it out with other people. Like and subscribe. Okay, let's dive into what a return and what a return really is, how we're going to use that information, how we're going to get the most out of it. So number one, I'm going to give you a real simple golden rule, right? If the IRS owes you money, get your return done quick. If the IRS owes you money, get it done quick. If you owe the IRS money, by all means, pay it by April 15th, but file an extension. File an extension. And the reason being is because it gives you the most opportunities to still take advantage of tax deductions for last year, even for the previous year, then you'd be shutting the door otherwise if you file too soon. And so there's two distinct things that we look at whenever we're dealing with taxes. Number one, the taxes owed, and number two, the filing of the tax return. And if I ask you, when are your taxes due? The answer should be, as I earn them, in the quarter that I earn them. In the case of if I'm getting wages, my employer is actually taking withholdings. If I'm self-employed, then I'm paying quarterly. And there's some safe harbors and things like that that keep it. Otherwise, the answer is really April 15th. That's when my taxes are due. So whatever my taxes are for last year, I have until April 15th to get them paid, right? Now, again, you're paying them as you go, so ignoring quarterlies and withholdings and all that, it's April 15th. You should have paid them as you went. If you didn't, then there might be some little bit of small penalties, but nothing major. Now, here's where the big stuff comes in. So I have the taxes due on April 15th. When is my return actually due? Well, you get a 6-month automatic extension for the filing of your return. So it's actually October 15th. So a lot of people think of those two things as the same. My taxes are due to be paid by April 15th, but my tax return is not due until October 15th. And they go, well, why wouldn't I just file it on April 15th? I've never been late. You're not late. It's an automatic extension. That's like your teacher, if you were in high school or in grade school, saying, we have an assignment that is due on Friday. Or if you'd prefer, you can turn it in on Monday. You just have to let me know you're going to turn yours in on Monday. So if you want the weekend to work on your homework, you can have it. All you have to do is let me know. And if you're one of those people that turns it in on Friday, more power to you. But what if the homework involved something that was somewhat timely and involved some complexity that maybe more information came out about during the weekend? In fact, maybe it was current events and you're writing a paper on a current event story that was still unfolding. And then on Saturday and Sunday, more stuff came out. And here you are, you've already turned in your homework, and it's completely wrong because of things that happened on Saturday and Sunday. And you completely screwed yourself over because you filed it on Friday, right? Barring anything extraordinary, you should always take that extra time. It doesn't make, there's no real reason to do it unless there's an incentive. And let's talk about the incentives real quick. Why would you file your return early? The only time you'd file your return early is if you're trying to get money back or if it's a condition of getting something else that you want. So that so it may be, hey, I'm trying to get a home loan, therefore I need to file my taxes so I can get my home loan. And even in those cases, depending on the type of the lender, you may be able to give them a return that is signed by you that's not filed yet. And you're just waiting. And the reason you wait, guys, is because I've been doing this for 20-something years. On multiple occasions, there's new forms that came out, I think it was last year, that there was tax law changes that occurred after the forms were actually put out into the public. So people had this information, and this is how I file my taxes. It was on unemployment as to what portion of it was non-taxable, and it was 100% taxable. And then they said, here's a portion that is not taxable, like $10,200 or something like that. People that had already filed now have to go back and amend. pain in the katush, right? I think that actually the IRS tried to do a workaround. They said, hey, we're going to do it automatically, et cetera. But if you were somebody that filed the return early, then you're put into jeopardy. Like there was a period of time where you're like, Now, typically when things change, they don't do that. They don't say, oh, you don't have to do anything. Usually you have to file an amended return. Or if it's from a company. So for example, I remember when the reporting requirements for options came out and brokerages all of a sudden had to provide taxpayers with information, and they screwed them all up the first year. Like they were all wrong when they sent them out. So taxpayers got amended 1099s, 1098s, all these things. 1099s was the big one. They got these amended statements in May of that year. So that May of the year following the year that the occurrence, the taxable event occurred. So if this is right now or in 2022, it would be, hey, for stuff for 2021, it comes out, they give you a form and they say, here's how much income, here's how much capital gains, et cetera. But they had it all wrong, so they had to restate it. Oops, the way we were calculating things was incorrect. Here's your correction, and they gave it to you in May after you file the return. So now you're going to get a letter from the IRS saying, hey, your documents do not match your return. Here's the extra amount of tax. You're going to be filing an amended return. Like you're going to end up having to get interaction with the IRS as a result. Other situations that we see, and we see this all the time with people that own real estate, are in private placements, or own businesses, which is you're going through the summer and you're uncovering things as you go that occurred the previous year. You're getting, hey, let's take a look at this. We're looking at our books. We misclassified that, or hey, I think we did this one incorrectly, or hey, we had the option to accelerate this and we didn't. Maybe we should. It's going to lower our tax liability. That is very, very common. We see it all the time. And if you filed your return, now you're having to go do it in amendment if somebody else gives you a different K1. So if the company, like let's say it's an S Corp, amends its K1, now you're in a situation where, you're going to get kicked out a letter from the IRS, so you're going to have to amend your return. Other areas we see this is, let's say you are either self-employed or you own an S Corp and you have a 401k. And you have the ability to make contributions for last year all the way up until you file your tax return. So the company, if it's an S Corp, can make contributions to your 401k that is deductible to the company, which then passes through on your return as a deduction. Get me? It's going to reduce the amount of profit. So if you have an S Corp, for example, and it has $100,000 of profit, but it never made a contribution on your behalf. And let's say you took $100,000 of salary, you never deferred anything in. So you have the ability to have $25,000 funded from the company into your 401k, 25% of your salary. And the company hasn't done it yet. The company can do that all the way up until it files its tax return. So an S Corp return due in, let's say it's March 15th, they file an extension for 6 more months. And in September 1st of 2022 decides to make a $25,000 contribution. It now lowers your income by $25,000. If it files its return on March 15th, you can't do that any longer. Or if you're a sole proprietor and you file your return early, you just locked the door for doing like a SEP IRA or things like that, or even doing your own 401k now. And yes, you can actually do 401ks after the year end. This is the first year we're able to do that. So technically, you could set up a 401k and make contributions for last year, even if you're a sole proprietor. Yep. So you're closing the door on those activities. Other things we could do, if you're in real estate, we could do cost segregations all the way up until October 15th or the date that returns are filed. If it's a partnership, it'd be September 15th. If it's you, October 15th. You can make change of accounting elections all the way up until that point. So the best advice I can give anybody, pay your taxes when they're due. Pay your taxes, if any taxes, additional taxes are due by April 15th. And when I say that, are they due? Like as in quarterly taxes, if you have quarterly taxes. If you don't, then it's just April 15th. But make sure that you pay your taxes, but file an extension if you're going to owe money, because we still have the ability to lower the amount that you owe, or even turn it around and make it to where you're getting a refund. If you are owed money, by all means, jump in and file that tax return early. Now, here's some golden rules for you. Number one, e-file. Do not do this paper. Right now, the IRS is behind the 8 ball. You're going to be waiting for forever. So if you think you're owed a refund, e-file only. Number two, make sure that you do the direct deposit. You do not want to wait for the IRS to send you a check because they are months and months behind. Like, we are still waiting on things that we were required to do paper last year. We're still waiting for today. It's been months. In some cases, it went over 12 months. So do the direct deposit. Do not put the ball into the IRS's court to send you a check because you may be waiting for a while. It's instantaneous if they deposit it straight into your account. Number three, make sure that all documents are attached to that return that need to be. So you have everything from your W-2s, your 1099s. Make sure you have all that information, your 1098s, if you have mortgages and things like that. Make sure everything is attached and you're accounting for it all. One of the worst things that can happen is you file a return and realize, oh, shoot, I never got my mortgage statement. Or, hey, I never got this tax document for this income over here. And by the way, like Venmo, PayPal, Zelle, they're issuing 1099s this year for the first time for individuals that receive more than $600. Even GoFundMe, $600. Like it's going to be allocated out, 1099. So if you do not have that income reported somewhere, guess what you get? You're going to get a letter, right? It's going to say your return doesn't match. We're looking at your return now. So make sure that you have all the documents. Other things that are this year specific is the IRS is sending out letters for the economic stimulus payments and for the advanced child tax credits. Those are tax credits, by the way. These are not deductions. These are dollar for dollar against your tax bill. And if you have more than the tax bill, it is cash in your pocket that they send you. So they sent half of it out in the last 6 months of what they believed you were owed due to your 2019 or 2020 taxes. So for those of you who have dependents, and it's not an alternating year thing, like you didn't go through a divorce and one parent gets to claim them this year, the other parent. If you have dependents and you received half the money, you're going to get a letter that says, here's the portion that you received, here's the portion you're still entitled to. Attach this to your return or use this information. I don't think you have to attach it. They have another form where you do the calculation. You say, here's what I'm owed or here's what I do owe. If you are one of those individuals that either had someone that's no longer a dependent, they claim themselves as a dependent, or another individual claimed them as a dependent, and because it was on your return last year, you got this money, you're having to pay it back. It's going to be something that you're going to owe. So make sure that you're including those documents and that you're making sure that everything matches up. You do that, by all means, go ahead and file that return and get that money back early. If it's not in that situation, then I would suggest you look at punting, filing an extension. For the most part, I always encourage investors to file the extension. People say, Toby, you're going to be late. You're not late. Taxes are due October 15th for individuals. For S Corps and partnerships, it's September 15th. It's an automatic. You don't have to qualify for it. You just have to say, give me the extra time, just like homework. Hey, teacher, I'll turn it in on Monday. Even if it's done on Friday, I want to wait the weekend just to make sure nothing else changes, just that gives me the option to improve my situation. Speaking of improving your situation on your taxes, you want to get the most out of that return. Understand this. First you adjust, then you deduct. First you adjust, then you deduct. Adjustments are things like if you're an educator, you're a teacher, you get your educator expense. It's called an above the line deduction. What types of things are above the line deductions? You get a portion of self-employment taxes that you paid if you're self-employed. You get to take that deduction off the top. If you have self-employed health insurance or you're an S Corp and you have health insurance, you're going to take that off your return before you get into anything that are itemized deductions. It's going to be taken off the top. penalties if you have early distributions from IRAs, alimony payments that you paid to somebody else, charitable giving for 2021 up to $600 of cash per married filing jointly or $300 for single, you can write off above the line. Yes, I said that correctly. Some charitable giving goes above the line. The rest is going to go on your Schedule A below the line, which we'll hit in a second. You can make IRA contributions. You can make for retirement, individual retirement accounts, or this is really individual retirement arrangements. That's what IRA actually stands for. You get to take that off above the line. That's an adjustment. Your HSA, you make that. Like, there's no reason not to do an HSA, guys, if you qualify. High deductible plan for insurance, which, you can go look up the requirements. You get to put in, I think it's 7,000, a little over 7,000 this year as a family, that you will never pay tax on. You get a deduction for it, plus you'll never pay tax on it. It's like a Roth IRA on steroids, and it can be invested just like other investments. It's great. And then student loan interest. All those things come as adjustments that lower your taxable income, which is called your adjustable gross income, AGI, my adjustable gross income. Here's the amount of income that I have that then I look at deductions against. What are the deductions? Well, that's where you look at your Schedule A and you start determining whether I take the standard deduction or do I take a combination of my mortgage interest paid, qualified mortgage interest, which is $750,000 of home acquisition indebtedness, the mortgage interest on that, or if you had your mortgage before 2019, or 2019 or before, it's probably going to qualify for the $1 million mark. But you take your mortgage interest, you add in your health expenses above the 7.5% AGI amount. So you have to do that little bit of a calculation. You look at your state and local taxes. They're capped at $10,000 right now, but you take that and then you add in your charitable giving, not the $600 you took out on above the line or the $300, depending on whether you're single or married, filing jointly. But whatever amounts in excess of that, you add all that up together, and if it's better than your standard deduction, you take whatever that amount is that's on your Schedule A. So you're doing a comparison. Which one is better? It's like $25,000 standard, or do I take the $17,000 that I added up when I added up all those items? You're going to take the standard. More than 80% of the people take the standard right now because it's so high after the Tax Cut and Jobs Act. So if you have adjusted gross income, so you do here's my gross income, I do all my adjustments, I have my adjusted gross income, AGI, and then you have your deductions, that ends up being your taxable income. And that's what a lot of us really focus in on, because you're always going to see these people going, oh, Schedule A, Schedule A. It's like, no. First adjust, then deduct. My AGI is dependent. Like, some of those items are dependent on my AGI. For example, the medical stuff. 7.5% above of my AGI is excluded from that number. So I need to know what that AGI is. If I can lower that AGI, then I get to write off more of the deduction. Make sense? It also lowers me for things like capital gain rates, things like that. If I can get myself, I'm married filing jointly, and I'm below $80,000, I have long-term capital gains rate and dividends rates that are at zero up until the 80,000. I think it's 80,800. But whatever that amount is, that 0% category is still sitting there. If you're single, cut that in half, right? But I have this period of income that I could receive that's long-term capital gains or qualified dividends that qualify for long-term capital gains rates that could be zero. So I'm going to be looking at that going, how do I lower my income? Can I still do some of these things even after the tax year? The answer is yes, right? We have until April 15th to do HSAs, IRAs. We have even longer on things like the 401k contributions or SEP IRAs. Like, we have lots and lots of time to do certain things. Hey, we can even do cost segregations up to the point to lower our income to accelerate some of the depreciation on our real estate. Hey, that's great. Or I could accelerate certain equipment in my business if I'm self-employed and lower my tax rate. So some things fall from a 15% bracket down into a 0% bracket. All that gets to be done. And that's how you get the most out of your tax return. Hey guys, if you like this type of information, smash that like button, hit that subscribe button, share it with anybody you think that would benefit from this information. Thanks, guys.